Welcome back to Finstride, your one-stop shop for sound investing guidance. In today's video, we'll look at a topic that's near and dear to everyone's heart: retirement planning. Have you ever considered how you may create a safe and comfortable future for yourself? You've come to the correct place. Whether retirement is a short-term or long-term goal, taking the correct actions now can make all the difference. Join us as we reveal the 5 critical stages of creating a solid retirement plan. Continue watching till the end to arm yourself with the information and skills you need to boldly walk towards a financially secure future. Setting clear retirement objectives, selecting appropriate retirement funds, making smart investments, and accounting for any tax consequences are all part of the complicated process of retirement planning. It is critical to identify one's retirement goals, which serve as a roadmap to a comfortable post-work existence. Common retirement accounts include 401k, IRAs, Roth IRAs, and pensions, each with its own set of tax benefits and withdrawal restrictions. Diversifying your financial portfolio among different accounts will help you plan for retirement more effectively. Investing intelligently is critical for the long-term growth of retirement money. It is critical to balance risk tolerance, time horizon, and financial goals to stimulate development while controlling risk. Taxes are important in retirement planning because they allow seniors to maximize their income distribution. Tax-efficient fund selection and careful withdrawal timing can result in significant long-term savings. Starting early, continuously contributing to retirement accounts, diversifying investments, being educated and reacting to changing economic situations, and getting expert counsel are the 5 core guidelines for a successful retirement plan. Even after retirement, tax issues remain important since controlling tax deductions and taking advantage of available tax benefits may have a major influence on post-retirement income. Step 1. Recognize your time frame. Creating a solid retirement strategy is dependent on 2 critical factors: age and predicted retirement age. The importance of these considerations is emphasized by the fundamental premise that the temporal gap between now and retirement has a significant impact on the portfolio's risk tolerance. This is especially true for people who have more than 3 decades till retirement. This longer time horizon allows them to pursue more risky investing alternatives, such as shares. Historically, equities have outperformed bonds over extended periods, giving the potential for considerable profits. Another critical aspect in developing a retirement strategy is the need to achieve returns that outperform inflation. This protection is required to ensure that the buying power of acquired cash is preserved during the retirement phase. Inflation can degrade the value of investments by 50% over about 24 years. As a result, providing returns that successfully counterbalance this corrosive influence becomes critical. As the individual goes through life, the makeup of their portfolio should reflect shifting objectives. In the early phases, the emphasis is on accumulating revenue and conserving capital. This calls for a greater allocation to fewer volatile securities such as bonds. These assets serve a dual purpose. They provide a steady stream of income while reducing exposure to inflation-related risks. Another wise strategy is to incorporate varied time horizons and liquidity requirements into the retirement design. Changing the composition of the portfolio in response to changing conditions is a critical strategic maneuver. Portfolio rebalancing is a procedure that matches the investment mix with the evolving time horizon, guaranteeing alignment with the individual's goals. When developing a retirement strategy at an early age, the compounding impact appears as a powerful ally. The decision to allocate monies into assets in one's 20s reaps significant rewards over time, drastically increasing their worth by the time they are needed. Moving to the second step, determine your retirement spending requirements. Due to rising living and healthcare costs, retirees frequently expect that their yearly expenditure will be 70% to 80% of what they spent before retirement, which is unrealistic. A ratio closer to 100% is required to have enough funds for retirement. Accurate retirement spending targets aid in planning since increased future expenditure necessitates extra savings now. An accurate estimate of retirement expenditures is critical because it influences how much you remove each year and how you invest your account. Underestimating or overestimating expenditures might cause your portfolio to outlive you, while underestimating can result in you not enjoying the ideal lifestyle. Longevity risk is another element to consider while planning for retirement, as people's average lifespans increase. Actuarial life tables may estimate individual and pair longevity rates, often known as longevity risk. Furthermore, you may need more money than you expect to buy a home or pay for your children's education after retirement. These expenses must be accounted for in the overall retirement plan. It is critical to revise your plan once a year to ensure that you are on track with your savings. By identifying and predicting early retirement activities, allowing for unforeseen expenses in middle retirement, and anticipating what-if late retirement medical costs, retirement planning accuracy may be enhanced. Step number 3. Calculate the after-tax rate of return on investments. When determining whether a retirement portfolio can deliver the required income stream, the after-tax real rate of return is critical. This indicator measures the real profits on investments after taxes and inflation are deducted. Obtaining a required rate of return of more than 10% before taxes is a difficult task, especially in the field of long-term investment plans. This strict requirement becomes increasingly unrealistic as one grows older. The justification for this transition may be seen in the composition of low-risk retirement portfolios, which mostly include low-yield fixed-income products. This mix was designed to provide stability and capital preservation in later life, but at the sacrifice of strong returns. Consider the following hypothetical situation to demonstrate this phenomenon. Consider a person who has a $400,000 retirement portfolio and desires an annual income of $50,000. In this case, a staggering 12.5% return is required to fulfill the income target, a premise that frequently contradicts actual investment realities. Strategic retirement planning, particularly in its early stages, lays the door for more attainable objectives. This proactive approach to portfolio growth promotes portfolio growth toward a more realistic rate of return. For example, early planning would anticipate a 5% return on a $1 million retirement investment account. The need to analyze the true rate of return after tax deductions is an intelligent issue in this context. Understanding one's tax situation throughout the asset withdrawal phase is a critical component of efficient retirement planning. This understanding ensures that predicted income matches post-tax earnings and helps to avoid unpleasant shocks during the retirement years. Here we go for fourth step. Examine your risk tolerance about your investment objectives. Retirement planning is a rigorous process in which portfolio allocation plays a critical role in establishing a precise balance between risk aversion and return objectives. It is critical to have a thorough understanding of both necessary and discretionary risks in the portfolio. One must also guard against the temptation to become a micromanager affected by the market's stormy waves. In the aftermath of a poor fiscal year, a subset of investors known as helicopter investors tend to overreact, micromanaging their investment accounts and pouring more cash into mutual funds. This reactive conduct results from a focus on short-term market noise rather than a long-term goal. It is critical to recognize that financial markets have long, undulating cycles of ups and downs. When the investment horizon is many decades long, the portfolio may withstand these changes, with its value ebb and flow in line with the market's rhythm. During market downturns, the wise strategy is to take advantage of the chance to buy rather than sell quickly. The temptation to panic should be resisted. To use an analogy, much as one would joyfully buy things on sale, such as 20% off clothes, a similar mentality might be adopted for equities during market slumps. One constant element to remember is to be comfortable with the portfolio's risk profile. The attraction of constant tinkering should be avoided. A well-structured, diversified portfolio that is consistent with one's long-term goals may endure market ups and downs without requiring continual intervention. Maintaining a firm, unshakable approach based on educated decision-making is the cornerstone of successful retirement planning in a world driven by market swings. Finally, fifth step for the day is maintain your estate planning. Estate planning is an important component of a well-rounded retirement plan that necessitates the skills of specialists such as attorneys and accountants. Life insurance is also necessary to guarantee that assets are dispersed according to your wishes, eliminating financial hardship for loved ones after your death. A well-thought-out strategy also helps to avoid the costly probate process. Another critical part of estate planning is tax planning, which must consider whether an individual chooses to leave assets to family members or a charity. A popular retirement plan investing strategy aims to provide returns that cover annual inflation-adjusted living expenditures while retaining the portfolio's value. It is advised that an individual consult with a tax advisor to find the best approach for them. Estate planning will evolve during an investor's lifetime, with powers of attorney and wills becoming increasingly significant. Working with a fee-only estate planning attorney can aid in the preparation and maintenance of this component of your overall financial strategy. Retirement planning may be simpler than you think. These 5 steps simplify retirement planning concerns. Consider these steps when you create a strategy to satisfy your requirements once you retire. Thank you for joining us. Don't forget to leave your thoughts and questions in the comment box. Also, do like and subscribe to Finstride for more interesting stuff. So secure your future today to ensure a prosperous tomorrow.